Whenever clients sit down with their financial advisor, a handful of questions almost always come up. For this week's Money Monday, Gary Garrison with Asset Protection Wealth Management is here to tackle the top 4 questions investors ask and why the answers matter for your retirement and financial security. Gary, I really like this topic because I'm sure a lot of people ask very similar questions.
They do. And today we're going to talk about the top 4 questions that I typically get when people come in and then how to solve those answers.
Yes, which the first one, am I on track for retirement?
Well, everybody wants to know that, and they want to know, do I have enough money? Is there any chance that I'll possibly run out of money in retirement? That's a big one. And we've got reports, and I'm going to show a couple of quick samples in a minute of how the reports look and how they answer and address that question.
Okay, so yeah, let's look at the reports here.
Okay, so the first one here is called the Compass Report. This is our retirement report, and this is only a small part of it. But you get a risk score based on your risk temperament, and this happens to be a 45. So that means you should have your assets sort of 50-50. Here's the current allocation for this client. They've got way too much in red money, which is at-risk money. And this would be how they actually should be invested based on their risk tolerance. So you can see there's a big difference there in how they are and how they actually should be and get the risk allocated correctly.
So you said the red is high risk.
Yes, and we have it down here. Green is safe money, yellow is managed money, and red is at-risk money, which is money in the market in portfolios or stocks. And this person just happens to have, the majority of everything they have directly in the stock market, in stocks and mutual funds. And their score is only a 45, so that means they've got way too much at risk, and that needs to be dialed down. And so when we propose a plan, it needs to be closer to this, where you have a nice balance of green and yellow money for safety. Because really what you're looking for here is peace of mind.
Oh yeah, absolutely. The next question is my portfolio too risky?
Yes, and market volatility drives that question, always. If the market's fluctuating a lot, they ask that question. But you want to have diversification, you want to have a balanced plan. And so we have a Comra report here that talks about your risk. And I love this report. Look at this. So again, here's how they are invested now, and here's how they should be, okay? But it tells you the likelihood of success in your retirement by sticking to your old plan versus moving it and rebalancing it correctly. So in this case, they had a 66% chance of success if they stay how they are. If they reallocate it the correct way, up here they have over a 90% chance of success. And then down here it just shows again, like if the same model here, but if they took a 30% loss in the first year, which has happened a number of times in the last several years, how that would affect it. And the numbers are even more dramatic. Now you're in the 30% chance of success versus 92%. So really, what this is talking about is you've got to make sure that you're allocated correctly and that you don't have too much at risk, because that can derail your retirement quickly if we have a big drop in the market.
Sure.
And then one more report I want to show you. So this is another report that just sort of shows you how you should be allocated based on those percentages. And based on the numbers, the statements that these people brought in, it shows that they should reallocate and move $500,000 into less risky investments in order for them to have a good, safe retirement.
But before you turn the page there, I'm looking at the scores, and you had said a score earlier. What's that goal
score? The score there is
45,
45, and they're currently at 95%. That simply means what percent of your investment should be in the market at risk and what percent should be in safer investments.
Gotcha. Okay.
And they've got, in this scenario, they've got just way too much directly in red money. We typically work in yellow and green. Yellow money is professionally managed portfolios where you're in the market can go up or down, but it's considerably less risky when you're in managed portfolios versus just in mutual funds, which the majority of the people are in. And green money are instruments that have principal protection, or the majority of it principal protected, so you have safety. So you got growth and safety available here, where here it's just all directly in the market.
Sure. Okay, the third question is, how do taxes affect my investments?
Let me go back real quick to this one. This is the Morningstar report on that previous one. I love this one. This shows your performance of your portfolio as compared to the market as a whole. And it's really important to know that, to know, okay, are they watching what I'm doing? How's it handling? And so in this case, they're earning less than the market. And then this last page here, Ansley, shows they're earning less than the market, yet they're taking more risk than the market as a whole. That is a red flag. That's a big red flag if you're taking more risk and earning less than the market. Typically, if you're taking more risk, you would expect to earn higher returns.
Right.
Less risk, less returns. In this example, they were taking more risk and actually earning less than the market was earning. So I think most people can see how these reports would be so valuable and so helpful in doing planning to kind of know where you are in your investments and where you should be.
Sure.
From a risk standpoint.
Definitely. Let's talk about if the market drops, what people should do.
Well, market downturns are timeless. You know, there's going to be market downturns at any period of time, and that's normal with investing. But if you're allocated correctly, as we saw in these previous reports, you don't really have to worry about it that much. That's part of being invested. You know it's going to go up and you know it's going to go down, and you know you're allocated correctly, then you're okay. You know that's expected, that the market's going to go up some and it's going to go down as well. You don't panic, you don't overreact, and you don't sell. Those are all horrible things. Now, if it was like the previous guy who had everything in red, they might want to take some immediate action. But if you're balanced correctly, that resolves that concern, and you can just relax and have a happy retirement, because it's more time in the market than timing the market.
Sure. You showed a lot of information today, Gary, and people can come and see you, and you will walk them through all these steps
Yes, we
with
will.
them,
Yes,
correct?
yes. We prepare these reports for anybody that comes in. They can hit the QR code there and schedule a time to come in and visit. There's no charge for these reports either. I just want to say that this is complimentary. This is what we do to help people when they come in, and then if they choose to use us to help them, we're flattered and more than happy to do so. And if they don't, that's okay too. But at least they'll leave knowing exactly where they are and where they should be.
Absolutely. Gary, great information as always. Thank you
Thanks,
so much for
Angela.
your time. Appreciate it. Okay, we'll have more Good Morning Arkansas after this. Stay with us.